Hey YouTube, this is Zach with Achilles Financial. Welcome back to another video on investing. In particular, we're going to be looking at the difference between growth stocks and value stocks. So the terms growth versus value is essentially the type of stocks that are going to be in that particular fund or that particular type of investment. So traditionally, you're going to think of growth stocks as more large scale, large cap tech companies that are looking to grow revenue and to reinvest that cash, whereas the value stocks, think of your Walmarts, your Home Depots. Those are going to be the ones that as they bring more money in, they generally will give that back to investors. The stocks that I'm highlighting today, or rather the ETFs, exchange traded funds, are going to be Vanguard's two growth versus value stock ETFs, and I'm just going to highlight some of the differences between the two of them. So for the growth fund, the key thing that I want to highlight is the difference that you see coming out of this current coronavirus pandemic. So as you can see that even at the lowest point over the past 5 years, if you had started investing your money, you would still be up 27%. The reason that I highlight this is because traditionally this is the lower level growth, or rather this is the high level fund. And if you had your money sitting in a bank account, it would have been earning anywhere between 0.01%, 0.05%, or if you have a really good account, maybe 1.5% a year. And here we're earning 26.88%, and they do provide a dividend here of 88 basis points. So what are the stocks that make up the Vanguard Growth ETF? If you look here, I've just gone to Vanguard's website. This is very easy to do with most exchange traded funds. I can go here, I can see how the fund has performed over time, but the important thing that I want to highlight for the group here is if we look at not just the average returns, although you can see that pretty great returns, what we're really going to be looking at is what makes up this account. As you can see, these are some big names that we've reviewed here on this channel, in particular associated with this coronavirus rally. So as you can see, we've got Microsoft, Apple, Amazon, Alphabet, which is that Google or Goog, depending on which class of shares we're looking at, as well as Facebook, Visa, MasterCard, Home Depot, Netflix, and Adobe. The only one here that I traditionally am not familiar with being a quote-unquote growth stock would be Home Depot and Visa, just because, again, traditionally they have higher returns on dividends, as well as they are continuously investing that money back into their investors. So a lot of companies here that we've seen some huge growth over the course of the past 2 weeks. We've seen another 10-20% from just Facebook alone, as well as Microsoft and Apple have just been absolutely killing it. So some of the advantages that we can have here with the growth stocks is the fact that they are looking to grow that revenue and by turn grow the price of the share of the stock. So that is how they are going to benefit you as an investor. So let's go look at the performance of Vanguard's other account, the value investment. So as you can see, we have the Vanguard Value ETF here up on the screen. What I want to highlight here is you don't see that massive rapid recovery that we saw from the growth funds. The reason for that is because of the capabilities associated with these companies. Not all of them saw that rapid turnaround like some of the tech stocks did that really are kind of benefiting from this. So much so that, as you can see, over 5 years, it almost would have been better to keep that money in a savings account. However, the key difference between these two is this growth is not keeping into fact the 3% dividend reinvestment every single year. So at the end of this, you still would have made money, albeit not at the same level. Although even at the 5-year level, we can see that we're still hitting at nearly 40% return. So what does this look like over the past 3 months? Again, we saw that same level of growth. We're going to go a little bit higher, that same level of growth all the way up to $120, and now we're at 101. That's still up from the lows of that 76. I think this is a great fund. There's a lot of value associated with it, and it is a different approach. So these value stocks are looking at a more consistent dividend as well as the larger, broader market share. So it's traditionally a more safe investment. If you saw on the Vanguard screen for the growth ETF, it was a 4 out of 5 in terms of risk to reward. So a much higher risk, much higher rewards. So the Vanguard Value you're going to see here has a little bit different approach. So as you can see here on the screen, we've got the stocks that are associated with this particular fund. I do want to draw your attention that this is also on a higher risk, higher reward, but the key difference here is this was not always at this level. It actually used to be a 3 before this started, and then we saw a lot of these companies experience trouble that we hadn't traditionally seen. So some of the companies on here that we should all be very familiar with just from coverage on the channel. We've got Verizon, AT&T, Intel, JP Morgan Chase, Johnson & Johnson, and the big boy Berkshire Hathaway. So these stocks traditionally do not have as much movement in price and in volume, although recently we've seen that change. However, all of these stocks pay a very high dividend. AT&T is well known as being one of the best paying dividend stocks out there. JP Morgan Chase, one of the big ones. Berkshire Hathaway, one of the things I want to highlight about this particular list is that Warren Buffett actually invests in most of these stocks. He owns a very material portion of JP Morgan Chase. I think it's 8 or 9%. He owns most of Berkshire Hathaway. That is his company. But he is earning billions on a yearly basis just from dividend income alone. So this, or what we see here on the screen, is just an example of the value stocks. What I want to highlight is you can build your own portfolio that you are going to utilize, whether that is a value, a growth, or in between. I'm just highlighting a way that you can invest in these type of stocks without owning the actual underlying shares. If you found that useful, particularly if you're not going to be looking at this on a daily basis. So check these out, start doing your own research. If you found this content helpful, please leave a like and subscribe. Thanks everyone. Talk to you later. Bye.